Hello and welcome back. My name is Josh, and today I wanted to give an update on Lemonade, which recently reported earnings. The stock was actually down significantly after earnings, despite pretty good earnings, but the reason for it was that they announced an acquisition. So Lemonade recently, for those who don't know, actually posted a video on Lemonade previously, so check it out there. But Lemonade is an insurance company, and they recently got into the car insurance business. They started out in renters, then home, then they launched pet, now life, and then they just have launched car insurance. And to accelerate their move into car insurance, they actually acquired MetroMile. MetroMile is a tech company that uses your phone to track how much you're driving and will actually price per kilometer how much you drive. So the company, I think, was started by David Friedberg. He's one of the people from the All In podcast, which is a podcast I very much like. He started another data company, but their logic was, well, there is individual risk in people. You might be a more dangerous driver than me. The number one factor that leads to risk, and again, insurance is all about pricing risk, is how much you drive. If you're twice as dangerous as me, but I drive four times as often, I'm still twice as likely to get into an accident than you. Again, these are simple numbers. I'm not really, but that's the logic behind it. Is the number one thing is how much you drive. So they do per mile insurance basically. And so MetroMile actually they went public via SPAC uh, through Chamath Palihapitiya, who's one of Friedberg's friends, and they're both on the All In podcast. They went public. How long ago? Uh, Here we go. Earlier, about a year ago. And since then, the stock trade, SPACs typically start at $10, trade up to 20, so doubled. And then since then, now it's all the way down to $3. So down significantly. Market cap is now at 400 million. So it was 1.2 billion when it was IPO'd. Um, And actually, when it says here, it says, they are buying them up for a value of 500 million or just over 200 million net of cash. So when they IPO'd via SPAC, MetroMile raised about $300 million in cash. So I think I spoke about this in a previous video, which I'll post here, but this is like enterprise value. When you're looking at a business, you want to see what's the value of the actual business versus the company. So the company has $300 of cash, so you subtract that from the market cap. So we see the business now is actually worth only $200 million. So to me, they're acquiring $300 million in cash and a business for $200 million. And the stock, Lemonade, went down 12%. It's up a little since then, but 12% of, we're a $4 billion company ish. I think it was at 4.1 before times 0.12. You're talking, it went down $500 million for a $200 million acquisition. So the market really didn't like it. But I have a very different opinion. I actually think it is a great acquisition. Again, car insurance is the largest market in the US for insurance. Um, Very competitive. And if Lemonade wants to enter this market in a significant way, they really need to uh, have an edge. And they have no background in this. And unlike life insurance, where there's pretty good ways of estimating risk from your life or your pet. Car insurance is very much, again, it's about the data you have and what you can say. Oh, men are more dangerous drivers than women, and older drivers, and this. The number one piece of data you want is telematics, and which is again like data on actually how you drive. This is why Tesla started an insurance company to insure Teslas, so Tesla Insurance, because they say we have the best data on Teslas. We know how well you're driving and whether you have the full self-driving features on, and so we can actually better better judge the risk you're taking when driving. And actually, the CEO here, Daniel Schreiber, I'm a big fan of his, actually had a great comment about this. So I'm just going to let this clip play and then make a couple comments.
Next year?
Well, I think we can. Sometimes we're called a disruptor, but what I always tell our team is that it's actually disruption that causes disruptors, not the other way around. And what I mean is the following. This industry is going through.
So you can see here also, again, speaking about the earnings again, it was down 12%, despite the fact that their actual revenue beat estimated revenues by a pretty decent chunk, and their adjusted EPS, that's earnings per share, also beat. Now, it might look lower, but that's because the brackets mean negative, so they expected negative $1.16, instead it was only negative $1.08, so they beat it by 8 cents. So again, they beat on earnings. So really, we can really say that because they beat on earnings, the reason for the drop is really the market really didn't like this acquisition.
Through the car space, mobility space is going through multiple revolutions independent of Lemonade. We're going for autonomous driving, cars as a service, electrification, loads and loads of transformations. And the connected car is one of them. So suddenly you've got these staggering amounts of data available for car insurance. But that's not how Geico or Progressive work. Berkshire Hathaway had their annual general meeting back in May, and they spoke there about how Geico has fallen short in using telematics data, these kind of data for their car insurance. In fact, the actual sentence there was, Geico has entirely missed the bus. Now, why is it? Why would an incredible company like Geico be so slow to use these available data streams for underwriting car insurance? And I think the answer is it doesn't serve their interests. 95% of policies written by incumbents don't use any of these technologies. And even the 4% that do it in a really watered down way. And that's because if you've been in the business of pricing insurance based on proxies like credit score and gender and marital status, you're taking wide swaths of the population and treating them as if they are monolithic and pricing them to the average.
This is a really important point. Again, when you're looking at insurance, it's all about pricing risk. So, if I say, hey, these are all, let's say it's house insurance. These are all houses in Toronto. We know that 1 in 1,000 houses burns down in a fire. You don't actually have to look at the individual house. You could just take a wide enough swath, say this is on the average, and if you get enough houses, you can be kind of certain about the risk. He's saying if you have better data, you can more accurately judge that risk on an individual basis. So rather than just approximating, oh, these houses are all average, maybe, just as an example, might seem like a dumb example, you say, oh, these houses, these 20 houses, actually really like to cook, and they cook every night. That increases their odds of a fire because they're using their oven more, and maybe they're flambeing. So these houses are actually much more risky, and these houses, they're not even occupied. No one lives there, so maybe that means it's much less likely to have a fire. Or maybe a better example might even be, life insurance. If you knew that one house is, ordering McDonald's every day and the other one is eating veggies, that might help you better price this risk. So again, he's saying that this is actually not a great pause for Daniel Schreiber. Sorry about that, bud. But he's saying that these car insurance companies are looking at very broad data. They're saying what's your age, what's your gender, and they're using that to price risk on a broad level rather than on the individual level.
And that works until a new technology comes along, which can actually discern the differences. 2/3 of drivers drive less than average. 5% of the worst drivers cause 10 times as many accidents as everybody else. And so long as you don't know about that, ignorance is bliss and you go about your business. But these new technologies, once applied to an existing book of business, would require something like 30% discounts for 2/3 of their customers and a huge rate hike for about 1/3 of their customers. And if you're the CEO of one of those companies, that's the last thing in the world you want to do. So they are dragging their feet and adopting these technologies. Lemonade, and particularly now Lemonade with MetroMile, coming legacy free without decades of old-fashioned business to protect, allows us to go all in on telematics, all in on data-driven insurance, and go not for proxies, but for precision. And that will benefit 2/3 of customers. That translates into 30% savings and more. And that is a huge advantage in such a price-sensitive and competitive market.
So a couple great notes there. So one, if you are a high risk driver, Lemonade now will know that, and so they're unlikely to be competitive with high risk drivers because, again, as he said, 5% of drivers account for, I think it was 10 times more accidents than the average driver. So let's just say it's, if 5% typically represent 5% of accidents, you'd say those top 5% represent maybe 50% of claims. These aren't exact numbers, but this is just, approximates. Let's even just say it's 30%. This is a massive, they are accounting for a lot of the claims, which is a cost to an insurance company. You don't want to have to pay out. So Lemonade, if you're pricing risk more accurately, you're saying, hey, if you're a safe driver and you don't drive that much, come with us, we'll give you a big discount. which will encourage those kinds of drivers to switch from Geico or somewhere else over to Lemonade. And if you're a not safe driver, you're a risky driver, they're going to give you a much higher insurance because for them to price you, they say we know you're more risky, so they're actually not going to be able to give you a good discount, so you'll stick with Geico. What happens then is that all the best in insurance, you have maybe 90% of clients never use the insurance and 10% do, or maybe in a year. But those 90% are the ones that help pay for the 10% that do cover it. And what ends up happening is that the safest drivers, the ones that are in that 90% that don't make a claim, more and more of those will end up going to Lemonade and they'll be taken away from Geico. And Geico will be left with only a riskier pool of drivers because the riskiest drivers, again, are better off sticking with Geico, who's not looking at their specific um, driving. They're looking at broad swaths, saying, "Oh, you're a man and you're married and you're 30, therefore we're going to give you this price on average." They don't know that you particularly are a riskier driver. And on an individual basis, it might not matter, but when you collect millions of drivers like that, it has a difference on your risk. So what I see happening is Lemonade is they're going to get better and better at pricing and risk, and they're going to be taking on more and more of these um, safer drivers. And again, the reason this is important is not because it actually adds too much to margin by itself. Again, it is good to get customers, but really to me, the way I see Lemonade is they're trying to be the platform for insurance. They're bringing people into this ecosystem. Once you get in, you're saying, hey, you know what? You also have car insurance. Bundle it with your life insurance. Bundle it with your home insurance. Bundle it with your pet insurance. And they can slowly increase the amount of money they're making from customers. So really, they want to get a lot of customers in here. And if we actually look at, I will also note Lemonade has the best investor relations section. I really, really enjoy it. So if you actually say, read our shareholder letter, I think it's the best shareholder letter out there. It's very easy to follow. So you have here in-force premiums. That's the amount of premiums they collect. Let me just shift me over again. The amount of premiums they collect. You have here gross earned premiums. That's how much of the premiums they kept. So in other words, were not paid out. So in the last year, in-force premium was 347. The premium per customer was 254, and their total customers was 1.3 million. So you can see customers grew 45% year over year, but premiums also grew 26%. That's a pretty big growth, and that's because they're adding on more insurance. You can see that they used to have, I think they have a chart here, maybe not. Maybe this is from last quarter here, Q2. Let's look at their Q2 one. I know they had a really nice chart here that showed here. It said it previously used to be 75% homeowners and renters. Sorry, renters represented 75%, and now it only represents 56%. That's because they're bringing in more types of insurance. So they're selling new products to their existing client base. Again, this is similar to Apple, where you get them on one product, you sell them an iPhone, and then they have AirPods. And then they also get the Apple Watch and this, so you can keep selling them products once they're in the ecosystem. So this is like that's the way I see it. Is Lemonade wants to be the ecosystem for insurance, and by adding in, you can see life is only less than 1%, and you don't even have car here. So this acquisition will really help speed up them scaling their car insurance one, which again is the largest market for insurance in the U.S. So I'm a really big fan of this MetroMile acquisition. It wasn't too expensive. It was only $200 million net of cash. So I'm a big fan of that. The stock price actually went down. So to me, I'm like, great. They're acquiring a company that I think is going to help their growth, and we get a discount. And again, the way I see it is this company really is ripe for disruption. And I mentioned in another video that this is some companies say, oh, we're disruptors. I like that he said, disruption causes disruptors, not the other way around. And some of these companies say, oh, we're going to disrupt this market, but there's not a clear path. With insurance, it's such a huge market. Even the largest insurance company makes up less than 5 or 10% of the market. This is not someone saying, hey, I'm going to disrupt Google and Apple, who make up, Google and Facebook, or Meta now, who make up 70% of the digital advertising ecosystem. That's tough. It's really tough when there's such high concentration levels. With insurance, It's such a big market, it's so fragmented that it's really easy to take a little slice of the pie and grow it. And that's really what Lemonade's doing. So I really do see them as a true disruptor in the insurance industry. Um, Again, watch my other video for more information on a deeper dive into like the product and why I believe in Lemonade Insurance. But really, I want to discuss their latest earnings and why I'm actually a buyer. I think I'm going to do some more purchasing today after the stock price is still down about 10% from a week ago. I really do believe this acquisition will really help speed up the growth in the car insurance, which I think is going to be a massive driver for them. Again, they want to acquire as many customers as quickly as possible, and there's previous stats that they showed where they're the fastest company. I think they got to 1 million customers 10 times quicker than it took Progressive. I think it took them like 3 or 4 years, and it took Progressive 30 years to get to 1 million customers or something like that. I don't remember the exact stat, but Lemonade is growing insanely fast. So again, while they're not currently valued like an insurance company, which is typically on PE, they're investing so much in growth because they're really growing at an extraordinary rate. And I really do think this company could be the ecosystem for is building something special in the insurance industry. So let me know your thoughts on Lemonade in the comment section below. Are you a buyer? Are you selling, holding? What do you think of the MetroMile acquisition? Thanks so much for watching, and talk to you next time. Cheers.